What's up, investors? It's the Russian Dude. In today's episode, let's talk about the Wall Street, which predicts which companies, potentially even next year, will be outperforming the stock market, and they present some very interesting data to support their claims. The very first piece of evidence they give us is the performance of the S&P 500 index and specifically majority of top companies within it. They basically claim that whenever their earnings reports, which they are releasing right now, if they beat the expectations, the performance and the reaction of these shares of these companies is nothing extraordinary, just a little bit going up or potentially even down. But whenever the performance, whenever the earnings report shows some bad results, then the situation is completely different. This is exactly when the share prices, they literally tank. And even though we already been touching the correction zone with the S&P 500 index, right now we are gaining some of the momentum back. But if you guys do believe in the technical analysis, those experts, they claim that if the S&P 500 goes below its 200 days moving average, then we might potentially see another correction of at least 10% more. And one of the main reasons for this, it is because the majority of retail and at some point even institutional investors, the biggest trades they are doing right now and the biggest holdings within their portfolios are exactly those top companies within the S&P 500 index. They are doing this in long positions, they're buying and holding them, which basically means if something bad happens, remember, if there is a bad earnings report, the reaction is extremely negative. So if something bad happens, this can trigger another chain reaction of a big, massive sell-off. All of these things I just mentioned, we guys already been talking about on this channel for the last several videos, so it all makes sense. So some of you might ask, so if S&P 500, if those magnificent seven companies are not that reliable, where should we invest our money? I honestly cannot answer you this question. I don't think it is even legal. I'm not the YouTube channel which is gonna suggest you buy this stock, it's gonna make you a millionaire, billionaire, trillionaire. No, nothing like this. Right here I'm just presenting you the news, some very interesting articles I find online, so it triggers your own investigative analysis, so you can maybe make a better investing decision for yourself in the near future. So with all that said, let's now talk about exactly which companies and particular sectors, industries and even entire indices the Wall Street is suggesting that most likely it will outperform the market in the very near future as early as already in the next several months. To answer the question right away, we are going to be guys talking about the Russell 2000 index, and here are the reasons why. First of all, more and more most recent inflation reports, they come at pretty favorable numbers. So pretty much the Federal Reserve, Jerome Powell, they can no longer complain that the inflation is no longer under control. We will most likely see one of the very first interest rate cuts already in September, pretty much next month. Some Wall Street analysts and financial experts, they predict there will be a total of 3 rate cuts by the end of 2024 and as many as we can expect, potentially even 4 rate cuts by the end of this year. At this point, the first rate cut in September is almost at 100% probability, the next rate cuts come at 54 and 46% respectively. So as you can see, the market mostly expects 3 rate cuts, every single one of them will be at 0.25% most likely, so we can expect the rates to drop by the end of 2024 by approximately 0.75 to entire 1%. And another interesting thing, even though it is usually the world which is following exactly what American financial system is doing, right now it is exactly the opposite. As you can see from this graph, the world central banks of different countries, they already started to reduce their interest rates at a pace which was one of the fastest pace of cutting rates since 2020. As you can see, it was only during some very high uncertainty and recession times when they were slashing the rates as fast. So basically, to say there is the entire process of rate cuts around the world already started, and now everyone else is waiting for America to do exactly the same. And according to Wall Street analysts from Goldman Sachs, The companies which will benefit the most from the rate cuts are the small and medium cap companies. Majority of them are the participants of the Russell 2000 index. One of the main reasons for this, they claim, is that their credit leverage, is that the amount of their borrowed capital is not extremely like in billions and dozens of billions of dollars like those Magnificent Seven companies, which makes maintaining such huge levels of debt to be a very big expense on their balance sheets. I mean, yes, these companies, they do have obviously debt and borrowed capital, but it is maybe mostly in millions of dollars, which is pretty manageable to pay down this debt. And so, logically, whenever the interest rates go down, this allows them to use even more of this money, which they were using to just once again pay down the debt. Now they can use it to the actual business purposes, merger acquisitions, research and development, and just hiring more people. As soon and when and if we are done with this cycle of the correction and potentially recession, after this is usually coming the cycle of economic upturn, which basically means a lot of businesses will be prospering, small businesses specifically, making more money than they used to just several years ago. And for example, when something similar happened whenever Russell 2000 companies were outperforming the market, for example, was during Trump administration, and this is exactly precisely what happened in the environment of low interest rates, in the environment where the economy was in a much better shape than it is right now, when there was not that much government debt or nothing like this. So yes, this was the fact, this is historically confirmed, historically proven, this is the best environment for small and medium cap companies. And another very important thing is that when and if retail and institutional investors will start getting rid of their big positions in these massive companies like Apple, Amazon, Nvidia, Google, Microsoft, and so on, Tesla obviously, they will have an additional capital where they want to invest somewhere else. I mean, some people will have tens of thousands of dollars, some will have hundreds of thousands of dollars, but institutional investors will have millions of dollars which are just lying and doing nothing. They will take a look at Russell 2000 companies, see that their multipliers are very attractive, and this is where this additional money theoretically should go to. And since those are small companies, the liquidity is not that big, as in once again these Magnificent Seven companies, the influx of millions of dollars can severely trigger share prices to go up and down in double digits. So as for now, according to the Wall Street, it is just a matter of time where this flow of capital from one thing to another, when it happens, the Wall Street is being prepared, they are selling some of their bigger positions, and they are keeping cash on hand whenever opportunities reveal themselves. Well, there you have it, guys. Thank you so much for watching. Please like this video, subscribe to my channel. This was interesting, informative for both, and see you tomorrow.